Hi, this is James Sugg at Westpac with the London end of day report for Friday, September the 14th. Well, European markets certainly benefited from the Federal Reserve's quantitative easing 3 program announced last night. I mean, it had largely been expected that the Fed would do something, but the commitment to do even more than the $40 billion a month if the labour market doesn't improve in the US certainly caught markets by surprise. And because European markets had been closed, and indeed mostly closed lower ahead of the Fed announcement, there was a lot of catching up for them to do. That was the main story driving European markets. In fact, I'll run through their numbers now. The FTSE up 1.4%, the French market up 2.1%, the German market up 1.4%, and gains in excess of 2% in both Spain and Italy. Now the ECOFIN meeting, that's the meeting of finance ministers, and also Mario Draghi, the ECB governor, president, down in Cyprus, we've seen a few comments come out of there, a bit of an element of perhaps complacency about the place, with no decision taken on the Greek bailout. Will they get the next tranche or not? Will they soften the insistence on another 11 billion euros worth of cuts? We don't know yet. No news on whether Spain will seek a bailout. Spain is now saying, well, yields have fallen already. We can afford this. We don't need a bailout. But of course, the reason yields have fallen is that there's an anticipation in the market that the ECB will buy the bonds of Spain, but they'll only do that if Spain seeks a bailout from the ESM, which we heard today, by the way, will fire up on October the 6th. That's when the first injection of capital from the various member countries that are contributing to it comes through, following the German Constitutional Court decision in its favour on Wednesday. So no economic data of note in Europe, apart from a 2-point fall in the core CPI for Euroland. It fell from 1.7 to 1.5% in August. Okay, so moving on to the US, we had mostly soft numbers there. I mean, retail sales rose 0.9% in August, but it was all in autos and gasoline. If you take those factors out, there was just a 0.1% rise in what we call core retail, with quite a few store types recording flat or negative outcomes. And in 3-month annualised terms, core retailing has been flat. In other words, June, July, August compared to the previous 3 months, no growth at all. And that compares to annualised growth in the previous 3-quarter period of about 3.5%. So a real slowdown in consumer spending, or retail at least, noticeable there. We did have consumer sentiment for September, however. The University of Michigan's index jumped about 5 points, so that was a bit more positive. Industrial production, however, fell 1.2% in August. Auto production was down. In fact, most sectors of manufacturing recorded declines. Also, mining and utilities were down too, so there was, as I say, a steep fall in the industrial sector. CPI came in at 0.6% in the US, driven by higher gasoline prices and a blip in food prices, but the core was soft at 0.1% for the second month running. So if you look at the data today, apart from that sentiment number, the US data was sort of weak in the core activity detail, and the core CPI was soft too. So you could argue a bit of ex-post justification for the Fed's QE program yesterday. So that's it for the data flow. We've got the Dow at the moment up 0.4%, so building upon yesterday's gains. The Nasdaq's up more than 1% today, and the S&P 500 0.6%. It's just going to go on 5 o'clock in London, so halfway time in the US market. Commodity markets, gold up 0.2% today, $1,775 an ounce. Oil's up 1.1%, $99.40 a barrel, almost up to $100, and copper is up 3% today. It's 383 cents a pound, and the Aussie dollar is 1.056 against the US dollar. It actually hit 1.06, $1.06 earlier today, but it's about just less than half a cent below that at the moment. All right, that's it for Friday. That's it for this week. We'll be back next week. Go dark. That ending's going to look stupid. Oh, they're going to hear that too.